Welcome to the Real Advisor Podcast, TRAP, TRAP. Please follow us and join in the conversation on Twitter @Advisor Podcast, where you can suggest ideas and themes you'd like the TRAP team to discuss. Also remember to like and subscribe to our YouTube channel and leave a 6 out of 5-star review on iTunes. Doing all this really helps us, which means we can do more to help you. Now let's head over to the studio for the latest pile of TRAP.
Yes, indeed, dear Trappists. Welcome back to what many people are calling episode 29 of the Real Advisor Podcast, TRAP, TRAP. My name is Lick Lincoln, and joining me as ever are the three other horsemen of the apocalypse: Andy Hart, Carl Dellavoce Widger, and Alan Il Narratore Smith. Now, gentlemen, we have a show packed full of absolutely nothing, so let's start unpacking it straight away with any number of high-energy review reads from my good friend, the Right Honourable Mr. Andrew Hart.
Thank you very much, boss. Okay, so the first review is a negative review, and we will read out all of the reviews, warts and all. So this is from Skinner G UK. It's entitled Bottled It, 3 stars out of 5. We can all stick to the stock line that a client being correctly advised is better than a client not getting no advice. It's telling Andy has income at stake, and the flack and loss of listeners prevented the warts and all summary of SJP. It remains the case their fees are commissioned by another name, and Andy, the self-proclaimed behaviourist, to turn a blind eye to the fact that this doesn't potentially make a difference to the outcomes is telling. I don't mind high charges if the client perceives value, but let's not pretend the remuneration doesn't distort behaviour. As I say, we're going to read out all the reviews, warts and all. You know, I made it clear on that show that, yes, I've worked with SJP and I still work with SJP on their programme of rolling out, proper goal-based financial planning for their clients. I see it from the inside. I've trained hundreds of their advisors. And I've also made it clear that I believe there's other factors that have a much more impact for clients' financial success than fees, such as real financial planning, proper investing, avoiding mistakes, a human advisor, holding your hand, etc., etc. Fees are, yes, one factor, but a simple thing to focus on. However, I appreciate the review, but infighting will not progress this mighty profession. Also, this them against us, again, I don't think helps. So appreciate your review, Skinner G UK. Finally, I'll finish on
Can I come in briefly on that, Andy, just to respond? Yeah. First of all, I can assure anyone tuning into this that if we felt, the other part of this group, if we felt that Andy was out of integrity or compromised or somehow saying one thing when believing another, he wouldn't get away with it. Gentlemen, he wouldn't get it. We would not allow that to happen. We discussed a lot of this stuff offline. And we wouldn't allow, we've got an accountability partnership amongst the four of us and other people that we know and hang out with, and you wouldn't get away with it. So it's not accurate what Skinner G said. The worst thing about that review was it's a 3-star review. I can deal with a 1-star review. When Andy Hart gave me a 1-star review on my own podcast, I thought that's what you want. You want to divide opinion. You want people to love it or hate it. 3 is kind of, so that's the worst thing about it. But fair enough. We can't always get 5 and 6-star reviews. On to the next one.
JM from Wanborough. What a big pile of TRAP, 5 stars. Love these podcasts. Ideal for new starters and old lags like myself. Client outcome focused. Nicely irreverent about a regulation. Serious topics done in an amusing way. I'm agreeing so much with what you guys are saying. Looking forward to the next steaming delivery. Thanks, chaps. Back to you, boss.
Excellent. Thank you for that. And thank you, Trappists, as ever, for the reviews. And as I said in a previous episode, going forward, if you want, you don't have to, by the way, but if you want to, put your proper name in your review. I know a lot of these are just sort of anonymous handles that you have to use. So if you want to, put your name in the review and the firm you work for. You don't have to, but it just means it'll just help create the sense of community. Because if we get a review from Anal69, for example, we might have no idea who that person is. We have an idea of what they get up to in their spare time. There's nothing wrong with that. It doesn't tell us about the person. So put your name and firm in the review. Obviously, if you're thinking about leaving your firm because TRAP has inspired you to do so, and we get quite a few of those reviews, stay anonymous, but just throwing it out there. And also, please do remember to subscribe to our podcast channel. Just download in the odd episode. It doesn't really help you if you want to listen to us on the go. Make sure you subscribe, and there it is in your phone of choice. every other Thursday. Right, great stuff. Thank you for that, Andy. Topical tidbits. Oh, for the love of Christ. Come on then, Carl.
Come on, Ireland.
Play the jingle, Nick. Play the drop.
Yes,
well, Ireland have...
Come on, let's do it. Let's do it. Come on.
And they'll also see that I was deeply uncomfortable with the content of some of today's podcast, owing to the Irish versus UK cultural differences. Yes, indeed, dear Trappists, deeply uncomfortable with some of the content from this morning's show already, but there you go. Yes, Ireland have beaten South Africa in the pool stages, and it was the most tense and brutal test match I have seen in so long. It was just bloody amazing. Two teams just going toe-to-toe, literally nothing between them. I wouldn't fancy having to play South Africa again. They're just a bloody awesome team, so fair play. The reason I put in the topical tidbits was to enjoy the journey. Is number one, we have no idea where this journey for Ireland might end. So all of us Irish rugby supporters need to definitely be enjoying it as we go along. But more to the point, so the crowd, these 9 o'clock French time kickoffs are allowing the Irish to really enjoy their afternoon before they go to the match, which sets out a raucous atmosphere and a lot of singing. So they have the shoulder to shoulder at the outset, and then we have the Fields of Athenry, and then we've taken to singing Zombie, which is a Cranberries song. Which Munster supporters started last year when Munster played Toulouse in the Aviva Stadium, and I was at that match, and Zombie was broken out. So Zombie seems to be the tune of choice post-game for all of our victories to date. And some people on Twitter are not happy. It's a song, and people are enjoying the game. So just bloody well go and enjoy it, everybody, and stop moaning about what songs people might be singing. Anyway, we have the next match, a very big game against Scotland. It's mad the way the pools are going, well, on the competitive pools, because if Ireland lose to Scotland, it could be that they actually go out. So this is, it's going to be a big couple of weeks coming up. Mad that England and Wales are looking like they'll get into a semi-final. But anyway, it is what it is. We won't dwell too much more on that. But I'm certainly enjoying the journey, and well done, Ireland. What a fantastic rugby team.
Yeah, absolutely. Well done, Ireland. And as you say, these 9 p.m. Paris kickoffs. In a couple of weeks, we've got Scotland versus Ireland in Paris, 9 p.m. kickoff. And I hear that some of us may be there. Some of us actually may be in attendance just to see what unfolds. So we might be reporting back.
I also hear that the Scotsman amongst us has booked lunch for 1 p.m. that day. As a colleague of mine here, says what could possibly go wrong. Anyway, really, just so looking forward to it. Just can't wait. It's, I just love rugby. Anyway, that's it. Nick, you've been very quiet during that little segment.
No, it's good. I'm conscious that not all of us are rugby fans, but the rugby. Yeah, it's going well. I mean, the Wales performance was amazing. They thoroughly deserved that. And England, you better be careful, gents, what you wish for. With each match, we're sort of sloughing off the Eddie Jones impact, which has worked so well for Australia, and slowly, perhaps regaining something approaching some kind of outside form. But this Rugby World Cup is progressing nicely, although this week is rubbish. The fixtures are rubbish, universally rubbish. The best game of the week is Scotland versus Romania. Yeah, exactly, dear Trappist. Okay, now I'm not sure if Mr. Hart's sound is working, so we'll come back to the Hum Cape Town part in a minute. Alan, you just crack on with your thing about IHT plans and AIM investing and the performance of such plans.
Oh, look, it was just a comment. There was a lot in the press recently, last weekend, about current government potentially disbanding or doing away or significantly changing and minimizing inheritance tax. Now, inheritance tax planning in the UK is a huge, I want to say, I don't know the data, but I'm going to guess it's a multi-billion pound industry in terms of the plans, the structures, the kind of tax minimization strategies. And if IHT is kind of done away with or significantly changed or minimized, it's going to kind of, I guess it's going to wipe out or decimate a huge part of our industry. And I just happen to be looking because one of the tools in the toolbox that advisors have historically been able to use is an AIM portfolio within an ISA wrapper. So a traditional ISA, if you hold AIM, so the underlying holdings are stock and securities held in the AIM market, which, as anyone knows, is a kind of smaller, early stage kind of micro companies, startup companies, undoubtedly much higher risk. And of course, the HMRC and the Treasury, they don't give away anything for nothing. So if you want to minimize your inheritance tax potential liability, you need to allocate a certain amount of funds into these high risk companies. And I just happen to be looking at historical performance of the AIM IHT portfolios, 5-year discrete performance. Now, 5 years is short term. We all recognize that, but the numbers are pretty telling. I can, again, doesn't take much research to find this out. For example, and I'm not trying to single out any particular companies, just do a quick Google search. You'll find that the Octopus AIM IHT portfolio, the 5 years to June 2023 is minus 26.9%. Bloody hell. Every time you do that, I get a bloody heart attack. And maybe rightly so for some of these numbers. Puma AIM, that's a positive, looks like 13.4. Interesting. RC Brown AIM IHT minus 21.5. Unicorn Dividend minus 13.1. And if you think of what like a global equity portfolio would have done over the same 5-year period, you add in most of these portfolios, last time I looked, have got significant charges, initial charges, spreads, or significant annual charges. I'll tell you what, all right, after 2 years, they're kind of exempt from your otherwise taxable estate, but you're better off not even bothering with these things based on the recent investment performance, based on the very high significant charges, and based on the amount of risk that you're being asked to take. I've never really been a fan. It's the old adage, what is blah, 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 tax tail investment dog. Don't let the tax tail wag the investment dog. That is another prime example. And it's just going to be interesting to see how this significant part of our industry is impacted by the removal or reduction of inheritance tax in the UK, should it happen. Thoughts, anyone?
I know this is going to come across as a little bit childish, but is one of those portfolios called RC Brown?
No, I was thinking that. I was RC Brown. It's like taking the mick, isn't it? Yeah. Sorry, Andy. I know Andy. You have slight trouble with the
RC Brown AIM portfolio minus 21.5. So make up your mind about RC Brown.
The AIM portfolio or the AIM index is always been a bit of an anomaly to me. It in some ways goes against our investing philosophy, as in invest in small, almost value, younger companies. Obviously, you're taking a lot more sort of volatility risk, but the return should be there, but they're not. So it's a very odd index. It hasn't done anything for, I think, about 30 years. So any company trying to individually select stocks inside this thing that does nothing, I think they're up against a tough ask. Again, I haven't looked into it for a while, but the AIM index has done nothing ever since it's been launched. It's a very odd index. As I say, it slightly goes against our sort of investing principles. So yeah, I just thought I'd mention that. So yeah, if you're trying to pick winners within it, good luck. And as you can see there, 3 of them haven't, and 1 of them has. But once you factor in the loss
but inheritance tax, that's the thing. Everyone gets excited about that. Oh, you're going to have minus 26% returns plus a 5% spread and 3% a year fees. Yes, but inheritance tax.
But after 2 years, you save 40% of a much lower number. Thank you very much for decimating my wealth. This is it. Yeah. People like to be sold shiny solutions to things. If they left the money in a portfolio, it need to have grown by X to then swallow up the tax hit. There's various ways to slice and dice it, and obviously we've picked a sort of period in time, but not cherry picked it. We just picked the latest information we can find for 5 years. But yeah, the AIM index has always baffled me. One day it might shoot the lights out for a period. Over to you, Nick.
on that point, I think more than any other index, because obviously when firms jump from like the FTSE 250 to the FTSE 100, their future performance falls out of the FTSE 250. And I think with AIM, it's such a, when the 1 in 20 companies, 1 in 30, whatever the odds are, actually take off, they of course then become properly listed and they come out of the AIM market, and that's where their performance. So what you're left with in AIM is all these companies that never quite make it, and a lot that go bust. So in some ways, it doesn't surprise me that the index has gone, nowhere for 30 years, if that's true, Andy, and I have no reason to doubt you. So that's probably a contributing reason why. Okay, thank you for pointing that out, Alan. Yes, an IHT, will the Tory government get rid of it? I mean, they might do. I don't see any Labour voters suddenly voting Tory. I don't see any Tory voters not voting Tory anyway. I mean, it's whatever. I think it's one of those taxes, actually, I wouldn't mind getting rid of because it's just a pain in the bum. Thankfully, I've yet to administer an estate for anybody, but I know that having to do so is a pain. And Andy, you made a comment in the group chat earlier. There's probably more time spent on collecting IHT and all the bureaucrats trying to get it than the actual tax it raises. Okay, we can't avoid it any longer. Smith Hart, you've been to, where have you been? Somewhere abroad?
We've been to the Southern Hemisphere. We've been to Cape Town. Yeah, we've recently returned. Spent just under a week there. It was my Humans Under Management Cape Town conference. It was last Tuesday, for people listening to this on the current Thursday. Mr. Smith was the international keynote speaker, so he spoke last at the event. I've had 5 events there, 2 being virtual, so this was the 3rd live one. Around 250 people in the Alan Gray building. Alan Gray's one of the big sort of supporters of the event. They're a sort of discretionary fund manager and platform in South Africa. Fantastic day, 12 speakers, good mix. Great people in the crowd, lots of people that listen to Trap. I think the score out of 10 so far is 9.1 out of 10, which is fantastic for a conference. We had an absolutely fantastic week. Lots of shenanigans and obviously lots of work was taking place. I stayed with Mr. Smith for 5 nights in a lovely, just to give some context about sort of the prices in Cape Town. This was sort of a 4-story house overlooking, one of the sort of prime areas in Cape Town. 4 of us were staying there, 4 ensuite bedrooms, just beautiful balconies, etc. It was £130 a night for the whole place. I mean, if you put that place in Ibiza, it would be £10,000 for the one night. We had a great time. Lots of fun, but also some serious business as well. Over to you, Mr. Smith.
You just want to endorse what you said. I mean, you had to kind of twist my arm to go out there. I thought that's a long way to go for a conference, blah, blah, blah. I had a fantastic time. We all had a fantastic time. Speak about the conference briefly. It was a great success. Lots of different people. I love the community. I'm going to talk about community later on. So another event I attended recently, but I just love, random people I've never met before in my life, just sort of coming up and speaking during the sessions and in between. And obviously we went for a drink afterwards, and it was just fabulous. There was a real sense of positivity. South Africa, as everyone knows, has got its challenges economically, politically, and otherwise. But there's just a great number of outstanding, positive people out there just doing the right thing. And a lot of them spoke, and a lot of them were sort of speaking in between the sessions. Really, really good. The place we stayed in was it was jaw dropping as you walked in. It was overlooking the bay. Had its own swimming pool. It had just different levels. I had the best room, obviously, being the international keynote speaker.
Well, no, being the oldest, Alan. I respect my elders, all right?
It was fabulous. One thing I would say as well, a tip to anyone who ever goes, on one of the day after the conference, I think we went out to, it's called the Graaf Wine Estate, in Stellenbosch, about an hour outside of Cape Town. What a spectacular experience that was. Just at the foot of the mountain range there, absolute 5-star. It's as good as any restaurant experience you're ever going to have. Unlimited. We were just we hit up the wines, the amazing wine, the food, the meat, the prawns, the steak, everything. And I can't remember exactly. I did pay the only thing I did pay the whole trip because, and it was, I can't remember what it was, but it was really inexpensive. It was really expensive. That's why I paid. That's it. So anyway, it was a really great experience. I loved it. Really, really positive.
It was lots of fun. Yeah, lots of fun. We everything went according to plan. It was almost like a Carlsberg trip. So yeah, it's a high bar for next year. Back to you guys, or unless you want to ask any questions.
No.
Look, you know what I think? It's like absolutely amazing to be able to fill a conference hall in South Africa with humans under management. So what you're doing is just spectacular. Well done. Kudos to you and respect. Fair play.
I just want to say my co-host in South Africa, Pierre Talliard, who's been absolutely instrumental in taking it out there, and also Rob McDonald, who also came to the Graf Vineyards with us. That maybe 3 or 4 bottles of wine in was sort of somewhat regretting taking me and Alan there. A lot of screaming over each other, but also a lot of fun. And finally, Carrie Bender also helps us with all the speakers. So yeah, there's a lot of work that goes into it. And also special thanks really to Alan Gray, who hosted us. And obviously you don't go to the conference for food, but my God, that food is second to none. Yeah, that's it. Onwards to next year.
Hey, Andy, it was great that our co-hosts on this supported us throughout the group, and they didn't leave our private WhatsApp group during the time we were away. That's interesting,
I know.
Wasn't it?
The support from them was just absolutely amazing, wasn't
Excuse
it?
me.
Absolutely non-existent. Thanks, Nick.
I sent a number of tweets and liked and commented on a number of tweets. I was supporting from the background, although I was led astray by our chairman. Any comments to make on that, Nick?
No. Okay. Alan, Progressive Planners Conference.
Right, you're right. Yeah, I mean, on the subject of conferences, as we've said before, we are in conference season. There's quite a few of them going on. I attended, I did a little thing at the Lee Robertson and his organization, who have this thing called Progressive Planners. Really interesting. A quick observation. There's almost like a different group of different community there. There's the people that go there that I don't see at Humans Under Management or other things. So they've got they've got their own community. There's not a lot of crossover as far as I can see, but it's fantastic. I went last year. It's a much. I can't remember how many people there. It's not in the hundreds. It'd be below 100. So it's quite a kind of discreet. It's a great venue, just off the Strand in central London. And I thoroughly enjoyed it. And I'm going to single out a couple of people for commentary. I had to get away lunchtime, so I was only there for the morning. But you'll be familiar with another guy who I believe tunes into, Dan Haylett. Dan Haylett spoke. Now, he's really kind of, from what I've seen, he's really upped his game. He's really got deep into the kind of the content creation. He's really focusing on the at-retirement, the post-retirement market. He's creating a lot of stuff. He's got his own podcast, which he's launched. And he did a talk, which I thought was fabulous. I thought it was absolutely fabulous. It will come up on the Octo platform in due course, worth checking out. It's worth actually looking or listening to his podcast and seeing the stuff that Dan's doing, because he's doing some really, really positive things, which is what we all want to hear. And the other thing I want to mention, and just to say, I've got this guy's permission to share this. During one of the breaks, I'm standing there chatting away as always, and a gentleman came up and approached me, said, "Hi, Alice." So I've never met him before. His name's Kevin Conlon. And he told me a story, which I won't have time to go into now, but he's been through a very, very difficult period of his life. He was a trader in the city, working crazy times and getting really stressed out. And he kind of just had a breakdown. He just physically broke down, and he was hospitalized for quite a long period of time. And sadly, during that period, his father died, who was quite close to. So he was telling me all this during, and I'm thinking, oh, where's this going? But I'm listening and showing some empathy. And he said, "I just want to let you know that your podcast helped me. It really got me through that whole period, because I needed to reassess my life. I knew I couldn't carry on doing what I was doing up to now. I wanted to. He was only 50, so I wanted to carry on working, and I decided to retrain as a financial planner. And the conversations that you guys are having, I can see it's a really positive community you've got. It's interesting work." He said, "I've got no shortage of potential clients. I know a lot of wealthy people through my job in the city over several decades." And he said, "I just want to let you know, I want to say thank you to you." And I tell you, it was was one of those moments, the hairs on the back of your arm standing up, back of your neck standing up. Really, really emotional, really positive, shook his hand several times and said, thanks very much. And we're still in contact, and he's going to continue to train as an advisor. He should be qualified at kind of CFP level next summer. And, who knows, maybe he'll come and work with us. Maybe but he'll certainly join our sector and our community and our industry. And I think the industry will be better for it. People like Kevin will be additive, will be positive to our community. So that was just kind of out of left field. I haven't really shared that with you guys before this conversation, but I thought that was really, sometimes the stuff we're doing, we're just having a natter talking nonsense often. It can be impactful. It can be really positive in the life of some people.
Yeah, that's amazing. Thank you for sharing that.
That is amazing. Yeah.
Kevin, yeah.
Good luck to that man. And
indeed,
fair play. Well done. Brilliant.
Okay, and we can't have an episode of Trap without an update about Future You, Mr. Wodge. Crack on.
So Andy said in our private WhatsApp group, here comes the 14-minute segment on Future You, right? So I'll be brief. Future You happened a couple of weeks ago in the Armada Hotel. It's a lot of work, right? So that's why I'm saying hat tip to Andy, to doing these things every year. Susan Walsh here in Metis organizes everything, but she has to coordinate all the speakers, the effort the speakers put in. We took a few risks. We did do, Sinead Gary did chair yoga. We went for a group walk. What I would say to people is, we got 100 people in the room, 98 to be absolutely precise. We didn't know about 50 of them, which was brilliant for us, obviously, because we've lots of meetings lined up afterwards. But what I would say is if you're going to do these conferences, just don't make it the same as everybody else. And do take a few risks, because what's the worst thing that can happen? You kind of go, well, that didn't really work. We'll move on. So amazing. Shout out to the folks in the Armada Hotel. It's an absolutely incredible venue in an incredible location. Couldn't have gone any better for us. I think the feedback has been phenomenal. Thanks to everybody who attended. And I would encourage all financial planning firms who are all about lifestyle and matching your lifestyle with your resources. That's real financial planning. Do stuff like this. We had psychologists, we had fitness and nutritionists. It's not all about the money. It can't all be about the money. So do it. Take a risk and do it. You'll be thankful that you did it. Is that okay, Andy?
Superb.
Thanks, guys.
Thank you.
Very concise.
Okay, we'll keeping the Irish.
But credit to you, Carl, because these things are risky. You took a risk. It's a lot of effort, cost money, and it sounds like it did pay off and it worked out. But it's just a moral. There's a message for many people there. Sometimes it's worth taking a risk. What's the worst that could happen? It didn't work. Fine. We learned another way of not doing it. We'll try again next year. So again, credit to you. You were the man in the arena.
Thank you.
Agreed.
Keeping with the Irish theme, Smithy, you've been to Dublin with your crew.
Yeah, I just wanted to throw this in there in terms of topical tidbits. Every year we like to, me and my colleagues will go on an adventure somewhere into Europe, just a kind of team building, bonding. We've been to Paris for lunch, we've been to Brussels, been to Amsterdam, and it was Ireland's turn. So a few weeks ago, took our crew, and this time we decided to stay the night, which is the first time we've done that, which is always a bit high risk, knowing my colleagues. If you're listening, boys and girls, you know what I mean. But and my good friend Mr. Widger here, the man on the spot, the Irish man, gave us a few tips and hints. And sorry, Shireen, that we cancelled our trip to the museum and the Book of Kells and went to the pub instead. But it was a thoroughly enjoyable experience. The restaurant, Carl, if anyone ever gets themselves into Dublin, the restaurant called Fire, right in the centre of Dublin, was absolutely first class. Really, really good food, really good fun. Obviously, we did what every tourist would do. Apparently, it is the most popular paid-for tourist attraction in Europe, which is the tour of the Guinness factory. Really, really fun, really interesting. Question for you, Nick Lincoln. What colour is Guinness?
Oh, I don't know. I don't know. No idea. Obviously not black.
It's not black. Guinness is red. Isn't that right, Carl? Guinness is red. And didn't you know? Yeah. So I learned a lot. Thank Arthur Guinness, incredible story. He took out a 9,000-year lease when he got that piece of land, St. James's, right in the centre of Dublin.
Grab yourself a drink, a very long drink. It's story time with Alan Smith.
The only real story that I can share, because obviously what goes on in Dublin stays in Dublin, was, everyone's behaving themselves. We're all having a really good old time. We did go to the Guinness factory and tried the Guinness and everything. It was a good experience. And we go out in the evening, and we were in this restaurant called Fire, and everyone's drinking cocktails and everyone's having a good old time. And inevitably, I move across to sit beside Olivia, who have been mentioned on this podcast before, who's the lady who used to work for Amazon and is now working with us and deeply entrenched in the world of financial planning, which she's loving. And I was going to have a chat with Olivia, and the inevitable coming together of a glass of red wine on the table and Olivia wearing white trousers and me gesticulating. Oh my God, it couldn't happen to a nicer person. I knocked a glass of red wine. It went all over her white trousers. I was cringing. I was dying. I could not have been more apologetic. I'm so sorry. Send me the dry cleaning bill. Tell me where you get the... So it was, a bit embarrassing. And she had to walk through the rest of the evening for the nights out wearing red wine-stained white trousers. So couldn't have happened to a nicer person. Apologized to her a million times, but hey, if that was the only casualty, which was Olivia's white trousers, then I think we probably got away lightly. But it was a great fun thing to do, and if people are doing it and teams and what have you, I think it's just a good thing to do. Take a bunch of people, on a trip. If it's a day trip, an overnight trip, it is a positive thing in terms of the team building. You don't have to do Tough Mudders and Out of Bounds and climb mountains. You can just go have a walk around the city, have a nice lunch, maybe have a couple of drinks, and all sort of meet up and hang out with each other. So it was a really successful trip, apart from the famous red wine on the white trousers incident, which will never be forgotten around these parts.
Thank you. And Olivia, our hearts go out to you for numerous reasons. My son's just on a Tough Mudder with his firm, Delta Financial Management, went down to Sussex last week. There's a great big field there, and it threw it down in England last week, maybe did in Ireland as well. So it was a very, very muddy, but great fun. I might do a team building exercise here, actually, at Vantage Division. Okay, moving on. Let's have a look. Mr. Hart, Nucleus buying Curtis Banks.
Yeah, I'll get onto that in a second. Just to close the loop on the point I made earlier about the AIM index. I believe the AIM launched in 1996, keep it simple, at 1,000. 27 years later, it's at 731. So over 27 years, it's just slowly lost about a third of its value, which is a very odd index. Okay, so moving on. It's a good
time to be buying, yeah?
Just like the units are very cheap at the moment. Pound cost, average yourself for the next 27 years. It's an incredibly odd index. Yeah, this is a story that I think it's happened some time ago, but Nucleus obviously sort of merged with Nucleus James Hay. They're obviously on sort of a bit of an acquisition trail. They bought Curtis Banks, who I didn't have any dealings with personally, but I know quite a few other advisors use them. It's relatively cheap purchase price. There must have been a reason behind it. 242 million. They've set up a new company to sort of deal with it. But yeah, they're obviously their assets under management for the Nucleus brand are growing. I think they're just over 80 billion now. Did anyone have any points on that, or was that nudge on?
No.
Nudge on. Okay, my next point is the US credit card debt breaches 1 trillion, which is somewhat of a milestone in the history of debt. Anyone who's sort of a fan of Ray Dalio has probably heard him talk all about debt cycles, short-term debt cycle, long-term debt cycles. There's a good link in the show notes of the Carlson Group in the US who go through this, and there's loads of useful charts. So if you're interested in this kind of stuff, like I am, do check it out. I think that's it from me, boss. Back to you.
Okay, thanks, Andy. So, I just saw something this morning, actually. In episode 17 of Trap, we had a topical tidbit around the UK stock market and its relative decline. Well, no, its absolute decline over the last 20, 30 years. To the situation now where it's about 3.7% of global market capitalization. It was around 10% of global cap 20 years ago. And apparently, according to the Telegraph, take it with a pinch of salt, the Bank of England are going to launch a new initiative searching for unconscious bias in the finance industry, and are going to ask all these companies in the city to submit these new returns showing the exact gender breakdown of their staff, their ethnicity, everything else. And you're just wondering, if you wonder why firms don't list in the UK, why the UK stock market is becoming less and less relevant to global capitalization, it's just because most boardrooms can't be asked with this crap. And you have to wonder what the Bank of England, what they can get away with. Their key job is just to keep inflation at 2.5%. Maybe focus on doing that, and not playing around with this nonsense. There's a link to that in the show notes. And with all Telegraph stuff, it's behind a paywall. But when the page is loading up, just thrash the escape button like a bugger, and that will get the page loading up. They've got a very weak paywall, and that's how you get Telegraph articles for nothing. If you're on the Telegraph board and you're listening to this, get back to doing your ethnicity studies. Okay, get back to filling out those forms. That share price won't collapse by itself. Okay, are we done? Are we good? I think we are. We're only 36 minutes in. Jesus Christ.
Oh, you're in good form this morning, Nick Lincoln,
right.
You must say.
Right. Meat and potatoes time, I think, gentlemen. And this is an interesting one. We've got to be careful. Yeah, okay. I'm not even going to go down there. This is about alternative investing for high net worth clients. And Andy will lead us off on this. I think that the theme of this is going to be, why do we as a profession sometimes feel obligated to put shiny objects in front of high net worth clients when actually they'd be best served by keeping it simple, stupid? Mr. Hart.
Oh, well, that's a good place to start. So this crops up all the time, and this is not going anywhere. Even if we, address it head on now, this is going to be a recurring theme forever. The issue is wealthy people on their journey to becoming wealthy have, the thought experiment is, if you want to buy, the best bag, it's expensive and exclusive and hard to find. You want to go to the best restaurants, it's expensive, exclusive and hard to find. You want to find the best investment solutions for your wealth, it's exclusive, expensive and hard to find. And then someone comes into their lives and tells them the truth around money. The lower fees you pay, the better, the simpler it is, keep it simple, all this sort of stuff. It's this misconception that wealth equals more complexity, more wealth equals more complexity. The most laughable, ultimate oxymoron, I believe, in the wealth creation business is wealth preservation. They want to preserve their wealth. I mean, in real time, their wealth is just absolutely decimated. The purchasing power is absolutely hammered, the loss of returns inside the portfolio. So yeah, the ultimate oxymoron is preserving wealth. But again, wealthy people like to hear that, and then people pander around it. So anyway, the sort of thought experiment is, let's say you have a client that starts off with a low amount of money. Let's keep it simple. They've got 1,000 golden coins, and they come to you and say, what do I do with it? And we tell them the truth, and we say, well, all the returns generally come from global equities. The best portfolio is one you stick to. Here's the solution. Off you go. They then get 100,000 golden coins, and they go, oh, I got 100,000 golden coins now. Is there something new? People love to be sold new and exciting things. And he said, no, same applies, same thing. Generally global equities, the higher proportion you can have in global equities, the better. The best portfolio is one you stick to. Then they get 1 million golden coins. They're like, right, there must be a secret door, something. Give me the code, give me the key, give me the exclusive stuff. And this goes on and on and on. Then they get 100 million. They go, surely there must be something secretive now. I've earned the right now. You need to show me this secret door. And the follow-on from this is the Norwegian Sovereign Wealth Fund. The Norwegian Sovereign Wealth Fund is about 15 trillion kroner. Norwegian kroner, which works out to be about 1.5 trillion US dollars. And they're public in what they invest in, and they've got the deepest pockets of anyone in the world. If there was a secret door, they would have the keys to it. And what they've basically done is they've invested 70% of their assets in global equities. They bought over 9,000 companies on public markets. They own about 1.6% of the world stock markets, and the rest they've put into generally fixed income and a couple of alternatives. So if that's not an example of, and also Warren Buffett's kept it very simple, Charlie Munger's kept it very simple. They say the returns are going to come from global equities, investing in the great companies and the businesses of the world. The rest is generally, sort of noise and sort of faff around the edges. And that's it. And financial advisors are always caught between this, the client's got a little bit more wealth now, so I've got to add a little bit more complexity into their life. What can I find that's alternative? And if you sort of back tested all these numbers, you'll probably realize that all of it is probably an utter waste of time once you look back on what they've potentially been up to. So, pandering to high net worth clients and looking for alternatives is very present and is here to stay, and it isn't going anywhere. And we see it all the time. So that's my starter. Who's next?
I'll throw in just to continue this. First of all, Carl, question: Norwegian Sovereign Wealth Fund, are they one of your clients at Metis Norway? They must be one of your bigger clients.
We're pitching.
Pitching with an alternative.
We're one of the 9,000 companies that they've invested in.
You wish. We kind of talked about this a little bit in the past, and I'm aware of a number of things. And exactly right, as you know, I guess all of us to different degrees will deal with people who have had liquidity events, people who have sold a business. And that's the classic thing. You get a chunk of money, then you get an earn-out. So the year after, or 5 years or 3 years, you get more money, more. And the natural thing is the client comes back and says, what shall we do? And you say exactly the same thing. And you say, and then we've got another, next year, get another earn-out. It's exactly the same thing. And so there's a kind of behavioral, psychological kind of mismatch there, because everyone wants diversification, but you've already got 9,000 companies. You've already got 10 or 15 or whatever it is, 1,000 companies. So one of the things that I reflect on, and I'm aware there's a number of things kicking around. There's some good advisors I hear talking about some sort of investment strategies and structures where, returns were 19% last year or something. And it all sounds a little bit bullshit, esoteric and out there. So one of the key things, I think this is really, really important. Anyone listening to this, anyone who's running an advice business or anyone's thinking of doing it or early stage, you've got to have a philosophy. You've got to have a structure and a philosophy through which you decide everything.
Totally.
And some of those programs and investments and what have you that you see kicking around, because we've got a filter, it wouldn't pass the first test. It simply wouldn't do that. Now, it might be amazing. It might well be. The chances are, looking at many, many years of historical returns, the chances of you stumbling across some alternative investment that's suddenly going to give you, on a risk-adjusted basis, a greater return than a simple portfolio of global equities. The chances of that are close to zero. There might be some chance, but it's pretty small. But the key thing is, unless you've got a robust philosophy and a filter through which you see every potential investment, you drive yourself crazy, because there's always a good story. There's always a good pitch. There's always, my mate invested in it and it got 19% last year. And so therefore I feel duty bound to share it with my high net worth clients, which is the other crazy thing. So my advice to anyone considering this is build a philosophy, build a filter, build a series of questions to say, does this meet with our philosophy? Yes, no. If yes, on to the next level. If yes, on to the next level. Because none of these things that I've seen kicking around they might pass the first one. They wouldn't pass the second or third, most of the things I've seen. So that's my advice to anyone. Build a philosophy and stick to it. Thoughts?
Yeah, I'll go next. I've kind of two thoughts about this. So if I can start the first point by using a kind of live example here in Ireland. So there's a product that has gone, an investment product that has gone pear-shaped here, and it's been in the financial press a lot over the last, probably for all of this year. It's called Solar 21. And I've put a link to an article that The Currency did, kind of detailing this investment and what's gone wrong. They raised over 230 million, I think, for solar. Do you call them solar wind farms or solar farms? Anyway, you know what I mean. And basically,
solar wind farms.
So yeah, you know what I mean. Anyway, it doesn't really matter. The point is, right? It's an alternative investment.
Clean
right?
energy.
Well, it's specifically solar, and they were building these things in the UK, by the way. So anyway, 230 million was raised, and there's kind of seems to be two kind of tranches of this, and tranche one is in big problems. Yes, Nick.
Sorry, mate. Are these solar farms for Ireland?
No. Well, they're being built in the UK, so
Right, I was
no.
going to say, but you don't. Yeah, it can't be Ireland, can it? Wind farms, I'd get. Sorry, back to you.
Anyway, getting on with my story, which has all been little bit disjointed thus far, so I'll try and be short and brief the way Andrew likes it. 26 million has gone in fees. 26 million has gone in fees. Now, 300 financial advisory firms in Ireland, or brokerages as they're called in the article, have recommended this to their clients. As far as I know, there are somewhere between 12 and 1,300 firms in Ireland. So 25% of the brokerages in Ireland have recommended this to their clients.
Bloody hell.
Bloody hell is right. Now, is this because the solar project was deemed this is going to be the one? Or is this because there was large fees attached? I don't know. Only each firm can tell you the answer to that. And I know there are some people who I like and respect have recommended this to their clients. So just putting that out there as well. But 26 million in fees. And that money is now, you'll read it in the article, non-recoverable. So this is the quintessential wealthy client. I'm not going to go with my passive ETF because that would be too boring. I'm going to go with something a little bit sexier. So clients don't need it. And these alternative investments have an awful habit of going pear-shaped. Yes, of course, you can be lucky, but they just have a habit of not going pear-shaped. Do you want to jump in there, Alan, before I make point two?
Yeah, just briefly, Carl, I just want to say, credit to you again for mentioning this, because you said something in a few episodes before and you got in a little bit of trouble about it within the kind of Irish financial planning community, because what you were effectively doing was calling out bad practice, sharp practice. And you're doing this again, and you're probably going to get a bit of flack for sharing this. But on a headline level, a quarter of the Irish advisory community supported this esoteric investment. A quarter, not a tiny outlying handful of mavericks, but a significant number. And I'm not down on the Irish community at all. And I know a lot of fantastic Irish financial planners, but it tells you something. And I'm sorry, but I do think it's part of our role here on this podcast to mention it, to call it out. We're trying to just we're not perfect by any means, but we're trying to call out things where we feel that the profession can do better. And this is an example. So again, I just want to support you and publicly say that, you're doing the right thing by calling out sharp practice. And we would do the same if I saw the same in the UK with that sort of numbers. I mean, 25%, if there's 25% of the UK advice market were involved in something like this, we'd certainly want to talk about it. Andy, you've got a point.
Yeah, no, I agree with you. 25% sounds like an astronomically high number. I mean, I put this into the financial trash bucket. Again, it's the principles. We're going to do things here which investment-wise have always worked. Anything which is working now, we avoid. Actually, a huge chunk of your fee that you're paying me is to help you avoid anything which is going to be working now. Again, we passionately do things from an investing point of view that so far have always worked. 200 years worth of data. A final point on the you're wealthy, therefore you need to have something complex. Warren Buffett's advice to his widow, who's obviously going to inherit a few quid, even though a load of it's going to go to philanthropic causes. He says to her, put 90% of your money in the S&P 500. He mentions a name, he mentions Vanguard, and keep 10% in cash. And he's the smartest, wisest investment business human being that's ever lived. That's his advice. Again, wealthy people just don't want to listen to it. They want to be, wowed by pirates in pinstripes, flashy Aston Martins flying around the city, and all the other stuff that they, the forces that are against them. Any final points on the meat and potatoes?
Yeah, back to Carl. Carl wasn't finished.
Yeah. So look, I am going to get myself in bother now, and I did before, right? And I suppose, look, what I had kind of decided on before was that, look, I'm going to just focus on what we do and maybe not, mention stuff in terms of negative, right? But I think it just needs to be said, right? By the way, I'm basing all of my what I'm sharing here on the article, so I'm assuming that the article in the Currency has the numbers correct. And my second point is going to totally and utterly contradict myself, and I'm probably a little bit alone in this group on this, or maybe I'm not. If somebody comes into an awful lot of money, right, through sale of a business or whatever, I am totally and utterly okay with carving some money out for a playpen or, stuff to
the dicking
invest.
around account. The dicking around account. We perfectly framed it.
Yeah, exactly. But I think that money should be just go and look at these, types of investments yourself. And maybe it's for kind of startups, or maybe it's for individual stocks and shares that you'd like to kind of pursue yourself and that kind of stuff. So I think that's relevant, because all I can ever base the advice that I would give people on is what I would do myself. And I know I would, if I ever came into a lot of money, that's what I'd like to do. I would put the vast majority into what has always worked. I do dimensional world allocation funds for my own pension fund. That's what I would do. I would probably tag on some Vanguard lifestyle strategies, that kind of stuff. And then I would carve out some money to maybe go and do stuff that would keep my own brain ticking over, and where maybe I could add value to some startups, that kind of stuff. So I'll always only give the advice that I would do myself, and that is what I would do myself. So I have to be honest about that.
Carl, I think we all are broadly in agreement with that. We've talked about this before. We've talked about the family fortress and the investment playpen. And we always say, never mix up long-term investment with entertainment, because that's what you're doing. That's what you're doing. I mean, the story behind solar farms, wind farms, is kind of entertaining. It's interesting, isn't it? There'll be some data and numbers that sound vaguely interesting. And of course, startups, to put money into your friend's new tech idea, your friend's children's idea or something, is all very entertaining. And there's dinner party stories. Global index funds are not dinner party stories. And that's perfectly reasonable. But what you were doing, and I bet this didn't happen with the solar farms investments, is you're assuming they're going to go to zero. That's the starting point. This investment, I'm going to assume within the plan, it's going to go to zero. If it doesn't, happy days. If you tell that to a client investing in a solar farm, I'm going to assume this goes to zero, you might get a different response. You might not invest in it. But if they say that's fine, I expect it, then fine. That might be part of their 5 or 10% of their total wealth. But I think we're all in agreement. It's fine to have a rush of blood fund or investment playpen, whatever you want to call it. It's just to scratch an itch. That's fine if you got enough wealth to do it. What are you thinking about this, Nick?
Numerous things. I'll go through them in order. If I had a client who was going to a solar sort of startup project or what have you, I would take your lead there, Alan, and I would say, okay, we're going to write this off then, and just let them cogitate on that for a little while. Because even if you can get a value on it, you never know what these things are worth until you come to sell it anyway. So it's not like it's not in their bucket, to use the financial planning terminology. It's not really a liquid asset. I would say, okay, we're going to put that down to zero, and you go and play with it. Playpen money, whatever you want to call, dicking around fund, the rush of blood account, the ROBA. Carl, totally with you, man. If someone comes to a significant amount of money and wants to have a little dick around on the side with some of that money, that's absolutely fine. But framing it in the way that you did is absolutely essential. And tying that back to Alan's point, we will assume this goes to zero in your financial plan going forward. This will be zero. Okay, we are not having any future cash flow liabilities met by this asset class, because we don't know if it's going to be there. And even if it is still there, we don't know if you can get your hands on it, because it's pretty illiquid. From a professional kind of point of view, I really do wish that we could hive off these kind of esoteric investments to a category of regulated individual who's not part of our milieu, because we're the mugs that pick up the bills for these things when they go wrong, and these things are so far off our radar. They're nothing to do with us, insurance syndicates, nothing to do with us, I don't know. So but that's just a wish. That's a wish list, and I shouldn't go on about wish lists. And the last thing, the Norway Sovereign Fund, really interesting story. There'll be a link to it in the so-called show notes. It's a really lovely website, very, very open. They just tell you everything you want to know about it. There's the reason why they did it, how it's gone on, and its returns since 1998 6% a year annualized, which actually is a pretty good return because they were going in towards the end of the tech boom, the end of the 1990s. They survived the lost decade of 2000 to 2009-10 and the various travails we've had since then. And that fund has beaten inflation by their metrics by about 3.5% a year. And that's all we're trying to do all the time when we invest. And on the website, they say most of the wealth of that Norwegian sovereign wealth fund has come from, not from the amount of money they put in, it's just from the compounding effect of growth at 6% a year. Yes, it lags a little bit behind the MSCI World or All World Index, but everybody does. Really hard to beat that. So an interesting story, and it kind of validates my beliefs and the beliefs of you guys here. Really, that most clients are best served by having one or two funds, massively diversified. The Norwegian Wealth Fund has 9,000 of the great companies within it. I mean, it's just beautiful. But keep people away from shiny toys. If they want to play with them, carve out a Russia Blood account and just assume it is zero. That's my overarching thoughts. I do get a little bit upset with those who have the same nomenclature as us being allowed to peddle this stuff, and then we're left behind to pick up the pieces. And this is a repeating theme, rinse and repeat. You can go back 2-3 decades on rubbish that's been sold in quotes to people by IFAs. And then it's everybody else has to pick up the pieces. But we know about that. Those are my thoughts, gents. Andy, you're waving digit.
Yeah, final point on Norway. All of my presentations this year, I've been shoehorning Norway into it and sort of trying different material. The other thing that was quite funny, they've bought 9,228 companies around the world. I think it's 70 countries maybe. And someone said to me, are they active or passive? They bought 9,228 companies. They're not active or passive. They're everything. They couldn't buy more if they tried. So I think that's quite an interesting point. Yeah.
I mean, if they knew what they were doing, they'd stick all their money in the Dimensional World Equity Fund, which has 13,000 of the great companies, but they're obviously learning on the hoof.
Correct. 2 final points on this. I totally get the point, Nick, and I think that the regulators need to step in here because having regulated firms selling unregulated products just consumes the retail or confuses the retail investors. So just say if you want to be regulated, you got to sell regulated products. You can't do the other stuff, right? And let some other cohort of investment gurus go off and do that, but do not call yourself a regulated advisor. And that the final point, right? Because no doubt I'm going to get myself in trouble, right? One piece of feedback I got, which was valid, from the previous article that I did myself with the currency was, does your memory only go back 10 years? All right. So putting this one out there, because did I make mistakes back in the mid 2000s? And did I recommend some stuff that I regretted recommending to clients? I did. There is no point in me saying otherwise. But what I did after that, I learned my lesson. I came up with, right, what are my values? What's my investment philosophy, and what's really important, which is real financial planning. So what I would urge, after all, this is dedicated to financial advisors. I know we do have some investors listening in, but for the financial advisors, try do right if you've made a mistake, but then you need to do some work on what your core values are, what your business values are, and what is your investment philosophy. And then you do what it says behind me here. You just stick with the plan and do not waver at all. Stick with the plan. So, look, they're my final comments on it. Yeah.
Very good. Have an ideology. Start with first principles. And then
Carl, you're right. We've all been on a journey. That's the point. The point is to be continually curious. When I first started all these years ago, a lot of this stuff didn't even. Vanguard went in the UK. Index funds existed, but they were about 1% a year or more. And
I think the Virgin one is still 1%. Amazingly,
yeah, Virgin, Halifax, all these ones. One of them 1.5% or something. I can't remember which one it is. It's just nuts. So they existed. So I was thinking at the time, well, I'm not using index funds because you might as well have a go. If it's the same price, you might as well have a chance than active funds. So we would use, that's all we did recommend. And we use multi-managers because I thought fund to funds type thing. And you look back now, it's quite funny because now we get sort of agitated about 5 basis points difference on a fund or something. Back in those days, there were hundreds of basis points per year, and you knew no better. But that's the point. You stay continually curious. You continue to learn, and you look back maybe 10 years ago. In my case, 19 years ago. We never invested in the famous shipwreck fund, though. That's my claim to fame, which we've talked about on this podcast in the past. But that's the point. Things that you do in the past, you learn from it, and you move on. And hopefully others who are recommending some of these crazy esoteric funds might have learned a lesson, hopefully. And it's all about better outcomes for our clients, which, after all, pay our bills. And they are the most important person and people in the whole setup.
Cool. Okay, I think we've been the meat and potatoes, a damn good thrashing there, which is just as well, because I can see out of my Nest camera that Posty's come up my drive. The sack is bulging, full of questions posed by our beloved Trappists. Yes, you, our beloved audience. This is your chance to fire questions into us, and we will give our opinions as and when we can. Sometimes the questions are a bit verbose, sometimes they're not. If you want to send us a question, there's a link in the pinned tweet at Advisor Podcast. Just click on there, dump your details in, and we will get around to it. Today's questions, we're now up to June. So what are we about? This is coming to October. We're about 3 or 4 months behind with the questions, but we will get to them. It's our duty to all of you to make sure that we do, because you are the show. So let's have a look here and see who this first one is from, as I desperately search for an effect. There we go. Jonathan Laws, who's on Twitter as @JLaws4, JLaws4. Oh, God, here we go. Long one. What are your thoughts on providing access to cash flow software direct to the client, i.e. Voyant Client Go? My thoughts are that whilst it is of great value add to the clients who use it sensibly and are numerate, it could end up causing more problems than it solves by helping clients go down a rabbit hole and or creating their own plans on suspect and or unrealistic assumptions. Whilst the advisor would still maintain oversight and the main base case plan won't change, they would not be controlling the planning process and could generate a lot of extra work that won't add any value. Long story short, thanks, Jonathan, only 20 minutes into your question. Long story short, I think it probably causes more problems for clients and achieving their goals than it achieves, but I would love to hear your opinions. I'll go first. I mean, yes, absolutely, don't do it. No value. Anyone else?
Yeah, I'll take this question. The other boys have sort of brought a knife to a gunfight in relation to this one. I think he's sort of answered his own question. Long story short, obviously you have the option to do it within Voyant Go. I've not done it. I train financial advisors who have been in the business 20, 30 years and they struggle to get their head around the software. So I would say do try it with a couple of clients and see how you go. I know Pete Matthews has done this very successfully and has hundreds of no-help DIY clients using Voyant Go software. And I believe it's not too cumbersome in terms of him managing that. On the back of that, I have taken on a superb client recently that had access via Pete Matthews, but then realized the limitations of it and was seeking a real human financial advisor and wanted to get help. So, yeah, I think just try different strategies with it. If you've got a client that is dead keen to get in the back end of it, then obviously open that up to them. Do I think this is going to be the future in terms of every single client that is in Voyant has potential access to the plan themselves and they can play around with it in their own time? I probably think that's where the puck's going, certainly with some of the sort of more tech-savvy younger clients that we're taking on. But yeah, it's definitely an interesting space. But I think you've answered your own question. Over to you, boys.
But to me, isn't it like a doctor giving you his stethoscope and his heart rate monitor? So just you have a go yourself at home and then come in. It's just these are the tools of your professional trade. That's why somebody hires you. You don't go and see a surgeon and say, "Can I borrow your scalpel? I'll have a go at doing a little operation at home." So I mean, I would just say no. I'm the professional. Is the Voyant thing available to anyone? Anyone could just go online, or do you have to get access through an advisor?
I believe anyone can go online and sort of have access to it as a client, or it used to be like that. Well, no,
you have to be a client. The general public.
This whole area is called the DIT movement, the do it together. Another example is a bit like Xero. So obviously I use Xero within my businesses. I know Nick uses Free Agent, but also our professional accountant has sort of more
we use
control
Xero.
over it. Yeah.
Yeah.
So it's called the DIT movement, the Do It Together movement. And in our space, it's it's sort of early stages with it. As in, the client fills in some information, they build a loose plan. We then come in as a professional, make some tweaks, then it goes back to them. So maybe it's gamification, doing it together. It's quite an interesting space.
Carl, you get any thoughts on that? No, don't do it. You're the professionals. I'm actually, to me, it's a slight red flag. I mean, I like working with clients who are delegators. They say, look, it's all, I'm busy running a company or doing whatever, or retired and enjoying my life. I'm not going to sit around, play around with bloody spreadsheets and online digital projections and forecasts and spreadsheets. That's not the ideal client for me. It might be for others. I think we've done that. Nick.
Okay. Good question. Thanks, gents, for your input to that. Okay, who's the next question from? Gorgeous George Agan, close friend of the show, close friend of I think all of us in the Trap Pack. He's on Twitter as Principles PF, Principles Papa Foxtrot. Hi, gents. Love the show. Keep up the great work. Whilst the advice industry has been around for some time, it feels the profession of being a real financial planner is still in its early stages. With a fair bit of innovation happening in tech, service models, and even selling part of business equity to clients, which we did discuss, that was Colin Lawson's idea, as mentioned in an earlier episode. Do the Trappists have any views on trends or how they feel the mighty profession may change in the next 10 to 20 years? Now, that's almost a deep enough question to have as a proper meat and potatoes if we want to do kind of forecasting, which is maybe we don't. I don't know. I'm not going to have a stab at that. Anybody? Carl, you were quiet last time, so on the spot, answer that question and be sure you're right with your answer.
Yeah, I thought I thought this one was Alan just sending it in so he could discuss AI. So
it's
obviously,
an obvious one.
Yeah, AI is going to be just to link the last question to this one, right? So I'm not like ruling out giving clients Voyant. It's not as straightforward. I don't believe anyway, as just everyone can have it. It's you've got to organize your licenses and all that. But surely that's one thing that's going to happen over time. The younger clients now, roll it on 10 years, they'll want this stuff. They'll want these tools. So do I know what's going to happen next? I can only talk from the Irish market. There are some seriously good firms who are now doing real financial planning. I see the Irish market is going to go that way. If you're not doing it, and I've spoken to some of them who aren't going to do it and are going to try and get out before this becomes just the norm. So I think in Ireland, real financial planning, that's where it's going to be at. And I would certainly hope then that, in terms of platform technology to be driven on, in terms of platform pricing to be driven on. The problem we have here, of course, is that we are a very small market. So, bringing competition in, we're gone down to two main pillar banks now, right? So that's why interest rates are rising and the banks are going, nah, we're not going to pass that on because there's no competition. So we do need more competition. But we don't need it in the traditional sense. We don't need more pension providers, that kind of stuff. We need more platforms. We need more, better technology that we can pass on to our clients. So it's all around technology for me. It's all around real financial planning, and it's all around competition. They'd be the three things that I would like to see, and I think will happen in the Irish market over the next 5 to 10 years.
Yeah, and I think that will, to varying degrees, be repeated around the world. Be repeated in the UK. The kind of what I see the future as being is absolutely playing into the hands. I see the world and the market moving towards people like us and the human-focused financial planners that listen to this, and those that are attempting to do. Just on that, and of course, it's just about technology, isn't it? AI is part of the story, but it's an evolution. If you can, never mind about, inputting data on Voyant, you will just be able to, your client will be able to just speak to a screen, open up their laptop or their phone more likely and say, I'm thinking of, taking a year off and traveling, but I'm thinking whatever this stuff is, and it will be done automatically. So historically, our entire industry and a lot of industries around the world have been built on what they call asymmetric information. We know more than our customer. That's why you've got doctors and lawyers and financial planners. We know the tax rules. We know everything else. That is going to be just eliminated over the next few years, because you will just be able to ask your phone a question as it pertains to you. In fact, your phone will be trained to give you a nudge and remind you the inheritance tax rules have changed. You might need to take advantage of this, that, the other. So what that inevitably means is an evolution towards uniquely human relationships. And what I've been thinking about recently is we are flagging that up in terms of a timestamp. We're all going across to Paris for the Scotland-Ireland Rugby World Cup pool match, which would be a fantastic
absolute shambles.
It would be far easier to sit at home and put it on your TV and put your feet up, and you're going to have no hassles and no problems and no sort of 3-hour queues trying to get into the stadium, and God knows what else is going on. But we don't want to do that because we are sentient beings and we enjoy the uniquely human experience. And this is the point. Technology exists for us to do this. It's just about consuming content. It's to watch a rugby match and get excited and all the rest of it throughout it. But we are choosing to have a human experience. And I think that's going to be repeated in a lot of sectors around the world, and particularly financial planning. People will want to deal with people, and will have all the robots and all the technology to do all that other grunt work that no one actually enjoys doing. Nobody enjoys inputting data to Voyant or whatever. It's not a positive experience. We enjoy being naturally human with other humans and chewing the fat, talking about life, talking about family, talking about future. And what I think is, just to answer George's question, I think I live in a bubble. I think speaking to you guys and the financial planners that I hang out with, and going to Humans Under Management and going to Progressive Planners and other conferences like that, it gives you a false sense of, well, all advisors are human-focused advisors, but I'm not convinced they are. I think there's a significant part of the advice community that are really good at technical information, at knowing the pension rules, at knowing how to run a spreadsheet, how to do a forecast. And I'm afraid they've got a short shelf life unless they're able to migrate towards the kind of right brain, relationship-focused financial planner. They're probably going to be out of a job within a few years. And this entire new kind of, we've been talking about it for years, but the uniquely human-focused financial planner, their time is coming, and there will be no other game in town. So continue learning about behavioral stuff. Continue learning about how it is to show up in the world as a human being, to build relationships, to build rapport, to have good quality conversations. That, in my opinion, is the direction of travel, and it's going to happen faster than we ever think. That's my point.
Yeah, great stuff. And I think, as a great man once said, there's more information, there's more data out there. People can do more of this stuff if they want to. I'm not sure that many people, even if they can just speak to a microphone and say, if I take a year off, does that affect my plan? A large swathe of people won't even want to do that because it's just not in their purview. It just doesn't interest them. Wisdom is sold separately. So much knowledge, so much data. Wisdom is sold separately, and wisdom is sold by an empathetic behavioural investment counsellor, I would suggest. And George, actually, who posted the question, he's an example of the change that we're seeing, really, in terms of content creation. I think, for me, that's the big... I know we talked about content creation since forever, but it really is now, I think, the epoch of this new dawn. And George is a very good example. He puts out these very nice YouTube videos. They're not overproduced. They're not... You watch some American ones, and they have they're coming in with the camera, coming out with the camera, they have and swooshes and everything else. But it's just nicely recorded. George speaking to the camera, giving content away, ideas around money and financial planning. That's a big change, and it's this thing about showing your work. And I think that's going to become more and more important because that makes you human. It humanizes you, shows you have a character, and again, separates you from the data. There's all the information. I have all the knowledge. There's all the numbers. There's all the info. But here's me as a human being. Here's how I can help you. Do you think we can bond? Do you think we can't bond? So that's what I would say on that. I think we're giving that a damn good thrashing, gents, as we're at almost 75 minutes in to the show. So I think we should move on without any further hesitation to Culture Corner. Okay, Il Narratore, Dumb Money.
Dumb Money. Just out of the cinemas. I think it just came out last weekend, and I took myself down there. By the way, quick aside, the Everyman Cinema. Very nice. There's a few of them around. There's one near me in Baker Street. sit in a nice sofa. They deliver food and drink to your seat. Good. You pay a premium, but it's a first class experience. Another example.
The
basic commodity is just watching a film, but the actual experience. Sorry, Nick. You saying?
They plumb a catheter in down. They say you don't have to move for 3 hours. You just sit there.
Exactly.
It's fantastic.
It's wonderful. So I went and I took my teenager along to see Dumb Money. This new film has just come out, and it's really entertaining. And one of the reasons it's entertaining is because this is a true story, and of course. Facts are stranger than fiction. And it was very recent. This is just a whole series of things that went on really from January 2021, which is obviously, pretty recent in the memory. And because we're kind of in the game somewhat. We're not in this kind of craziness that was going on in the US, but you certainly know a lot of the players involved, and they name names, and they have, they cut it with actual footage of what was going on at the time. So you've got the guy from this hedge fund called Melvin Capital. You've got Ken Griffin at a Citadel hedge fund, and he's sort of up to his eyeballs in all this kind of nonsense. You've got this app that was founded called Robinhood, on which you could just buy and sell stock on your... And so talk about gamified. You can buy this stuff, and behind it all was just social media. It was this platform, which I don't really know much about, called Reddit. And Reddit's got all these so-called subreddits and little communities, and they all kind of egg each other on. There's one guy in particular who's a kind of mild-mannered guy who worked as a financial advisor up in Boston, and he was just in his spare time to sort of buy stock, and he would post on it, and the whole thing around that. I mean, it's not giving the game away because it's well sort of known what went on, but he got behind an unloved stock called GameStop, which was a kind of video shop, sort of video game shop. You could go into their stores and buy video games, and it was very unloved. So it'd been shorted to hell by all these hedge funds. They bought it. It went up nearly 2,000% in the course of a month. It made instant millionaires, multimillionaires. This whole thing about take on Wall Street, it was sort of democratizing investment, blah, 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 blah. I'll leave the rest, but it's really well made, actually. It's a couple of hours long, very entertaining. And as I say, if you kind of knew what was going on roughly at the time, you can cast your mind back and you think, what was going on? We sort of collectively all lost our minds, or certainly a lot of people who participated in this nonsense. Relating it back to what we mentioned before about, esoteric investments or just a crazy investment strategy. Pile all your life savings, and of course, then they're borrowing money on margins. So they're borrowing 4 and 10 times their actual underlying investment, and that was obviously fueling the growth in it as well. So the whole world, or certainly parts of the United States, went collectively insane for a period of time. And no doubt that will happen again. Maybe it's happening already without us even knowing. Very entertaining. I recommend going along and watching it.
So I guess that was at the time of the lockdowns, wasn't it? Where people just had a lot of time on their hands and just were staring at screens all day, and the devil makes work for idle hands. But just to clarify,
it was lockdowns. It was the app that came along. A lot of them got these, what do you call it? The US government paid out. They just give them a payment. They gave them like $1,600 or something. Stimmy payments, they call it, to stimulate the economy. And they took this money. Imagine getting $1,600 and then putting it on margin on Robinhood and borrowing 10x against it. And then there was various other ways they were doing contacts for difference and a lot of really complex investment strategies.
God.
But of course, they made overnight millionaires amongst some of them. And of course, then they post that on Reddit, and the average person working in a kind of low-paid job think, well, this is my key out of this this dead-end job. This is the solution. So it was just collective madness. And it shows that markets can move quite quickly if thousands of people get behind them. It does actually show the impact of social media can have if you get a community, a bunch of people who all believe in something. But yeah, it was the perfect storm of craziness.
Yes, I mean, the microcosm of that story, that kind of madness of crowds thing is the thing you talked about in the last episode. I think it was, Alan. This crypto split off currency thing that took over the village of Winchmore Hill because the publican had made money on it, and so the rapist to his pub piled in. It's just, wow, human nature, a failed investor. Okay, great stuff. And that's at cinemas only. I think that's not on, you can't find that on your screen at home presently. Mr. Hart, Nick Murray books. You have a new source.
I'll get onto the Nick Murray books, just on a similar theme to what Alan mentioned. Panorama, BBC covered it, The Downfall of the Crypto King. This is the Sam Bankman-Fried story about FTX. It goes into a lot of detail about it. Again, it's on a similar vein to Dumb Money. Billions have been wiped out across the world. I think they had 100 million customers over 9 million customers, over 100 countries, whatever. Check it out. So yeah, The Downfall of the Crypto King, BBC Panorama. Check it out. The next mention is Nick Murray Books. Get sort of the recurring theme on this podcast. This one sort of slipped through the net, through the net, but it's called simplewealthbooks.co.uk. Go on there immediately as you hear me say this and buy all the books you can. I'm pretty sure if we get a good shout out to this, the books will sell out. I don't know who's behind it, but anyway, they've got the books on there for reasonable prices. When I say reasonable prices, you'll look at it and be like, 80 quid for a book. I'm not paying that. No. That's quite cheap. £70, £80. They've got if you're just going to buy one, buy around the year. £80, it would be the best £80 you ever spend.
What's wrong? I had a look at that, like £70, £80. What's wrong with Abe Books, which you mentioned before? Because the second hand they're like $5-6.
I don't think they stock.
Have a look at
Abe Books has the older one, has the ones from the 1990s and early noughties on there.
Yeah, I mean, getting around the year for 80 quid is an absolute bargain. There is a link in the so-called show notes, but yeah, it's called, if you just type it in, simplewealthbooks.co.uk. Knock yourself
just buy
out.
the old ones because they're all the same anyway.
Whoa! Okay.
Sacrilege.
Okay.
As someone who's not read many Nick Murray books.
He's not read them, but he's linked them. Carl, another high performance podcast. David Smith.
Yeah, I know. I felt bad. I'm going to mention the High Performance Podcast again. I'm not on their payroll, but you know what? I think it's okay. I just absolutely love this one. Now, Nick, this was a live podcast that was done at Fern Cotton's Happy Festival. I've bought you a ticket for next year. I think you'd absolutely love it. So anyway, the High Performance Boys.
Can you imagine Victor Meldrew at a happy conference? He walks in, angry with everyone.
Happy festival, my arse. Anyway, the two guys did the High Performance Podcast with a guy called David Smith, who I'd never heard of before. And look, I won't regale the story to you now, but it's an incredible story. So well told. It's emotional and it will make you feel lucky and grateful for what you have in your life. Definitely, please, everyone, listen to that podcast.
Okay, I'm going to do that. Carl, thank you for that. Appreciate it. I think at 82 minutes in, we're coming to the end of this episode. So that will be a wrap. Thank you, dear Trappist, for your precious time and your input into this show. Remember, this is your show. It's as much your show as it is us. It is shaped by you. The questions are fired in by you. The feedback comes from you, and we love that. Please do leave a 6 out of 5 star review on iTunes and leave your real name and firm name if you want to, just to engender more of a sense of community. Do like and subscribe to our YouTube channel, please, and do subscribe to our podcast as well. Don't just look out for the latest episode randomly. If you subscribe, it'll be on your phone in the early hours of every other Friday morning. And without
Thursday, Nick.
Thursday morning. Sorry, you're absolutely right. The early hours of Thursday morning. Thank you, Alan. So that's it. Until next time from the Track Pack, it's adios and take care out there, folks. And speak to you in 2 weeks. Bye.
See you later. Bye-bye.
Ugh.